Hello everyone. Now let's continue our discussion about budgeting, and we'll talk about the second part of the master budget, which is the financial budget. So while the operating budgets reflect the operating activities of the company, the financial budgets, which include the cash budgets and capital expenditure budget, reflect the financing and investing activities. So I hope you can remember the statement of cash flows where it had three different types of activities. We had the operating activities, we had the financing activities, and we had the investing activities. So we already covered the operating budget. Now let's cover the financial budget, which focuses on the two other activities of the statement of cash flows, which is the financing and investing activities. So the cash budget estimates the expected receipt, inflows, and payments or outflows of cash for a period of time. So within the financial budget, the first thing that we want to focus on is the cash budget. The cash budget is integrated with the various operating budgets. In addition, the capital expenditure budgets, dividends, and equity or long-term financing plans of the company affect the cash budget. A cash budget can be prepared annually, but because of the importance of maintaining sufficient cash, or other words liquidity, to run the operations of the business, cash budgets are normally prepared quarterly, monthly, weekly, or sometimes daily. So let's talk more about the cash budget. A monthly cash budget for January, February, and March of year one for the example company that we had, which is Elite Accessories Incorporated, is going to be prepared, which illustrates the multi-period nature of budgeting. The preparation of the cash budget begins with estimating cash receipts from the primary sources of cash sales and collections on account. In addition, cash receipts may be obtained from plans to issue equity or debt financing, as well as other sources such as interest revenue. To estimate cash receipts from cash sales and collections on account, we have the following schedule, which shows the collection of sales. So we have here the sales for January, February, and March. This is the budgeted sales. And then we have the accounts receivable, and this is the amount of accounts receivable for the beginning of January 1st. And then we have the receipts from sales on account. This is just basic information that is based on estimates. So 40% of the receipts from sales is going to be from prior month's sales on account, and 60% would be from the current month sales on account. So if we are doing February, 60% would be multiplied by this number, and 40% would be multiplied by this number. So 60% multiplied by 1240, and 40% multiplied by 1080. So let's apply that. So the budgeted cash collected for any month in the sum is the sum of the cash collected from the previous month sales and the cash collected from the current month sales. So to see this example, we said in February, 40% of cash collected on sales in January would be 10,000 or 1,080,000 multiplied by 40%, which is the January number, and we add to that 60% of the February numbers. And this is to calculate the February cash collected, which is this value here. So let's do it one more time for February here. 60% would be based on the budgeted sales for February, and 40% would be coming from the January sales. So we took the January sales multiplied by 40%, and that was 432,000. And we got the February sales, and we multiplied by 60%, and that's 1,240,000, give us 744. We add these two numbers together, and that will give us the total receipts from sales on account. And again, that's the budgeted receipts from the sales on account. So if we want to do this on the Excel sheet, again, we have the cash collected from prior month sales and the cash collected from the current month sales. The 480 here was for January. That was already given to us here. That's the value of the accounts receivable. And then we got the 1,080,000 and we multiplied by 60%, and that was the number for January. For February, again, we used the 40% and the 60%. So you see the 432,000, that's coming from the 1,080,000 multiplied by 40%, and the 744, that's coming from the 1,240,000, which is February sales multiplied by 60%. For March, we're going to do the same thing. We're going to get the 496, which is the 1,240,000. That's the February sales multiplied by 40%, and then we get the March sales, which is 970,000 multiplied by 60%, and that's the 582,000. We add the numbers together, and that would be the total receipts from sales and account for each of these 3 months. So that's the scheduled collection from sales. And again, cash collections. Now let's talk about cash payments or estimated cash payments. So estimated cash payments must be budgeted for operating costs and expenses, such as manufacturing costs, selling expenses, and administrative expenses, as well as planned for capital expenditures, dividends, interest payments, or long-term debt payments. So to estimate cash payments for manufacturing costs, a schedule of payments for manufacturing costs will be prepared. And here we have the same thing. So just to summarize again, we have the cash collections, we already talked about that, and now we're talking about the cash payments, how much we are spending, and that's also budgeted. So we have for January, February, and March, these are the manufacturing costs, where we have the budgeted manufacturing costs, these values, and then we have to also know how much is the depreciation on any kind of equipments we have. And in this case here, we have the machines included in the manufacturing cost. Why we care about the 24,000 here? Because this is a non-cash expenditure. Since it's a non-cash expenditure, we have to exclude it from the budgeted manufacturing cost just to see how much is the cash payments, excluding the depreciation. Remember, depreciation is not actual cash payments. So because of that, we have to deduct it from the budgeted manufacturing cost. So the 24,000 would be subtracted from the 840, the 780, and the 812. The accounts payable for the beginning of year 1 is 190, and the payments percentages would be 25% to cover prior year's manufacturing cost and 75% to cover the current month's manufacturing cost. So let's see how this works. So depreciation on machines, again one more time, is included in the budgeted manufacturing cost already, but does not require a cash outlay. Therefore, depreciation will be deducted. In other words, we're going to exclude it because it should not be included in determining the monthly budgeted cash payments. Also, manufacturing costs incurred in 1 month may be paid the following month. So, to see the example on February, which is this month here, as it says, the cash paid in February is 25% of the manufacturing cost less the depreciation in January. So we got the 840, we subtracted the 24,000, so the net manufacturing cost excluding depreciation is 816. We take the 816 multiplied by 25%, and that's $204,000, and that's the payment of prior month's manufacturing cost, of course excluding depreciation. And then we get to the February budgeted manufacturing cost. We exclude the depreciation again, which is the same value, 24,000. We get 756,000. We multiply by 75%, and that is going to be 567, and that would be the payment of the current month manufacturing cost, also excluding depreciation. We add these two numbers together, the 204 and the 567, and we get 771, and that's our total payments. So if we want to do that on an Excel sheet, we already did the month of February, we can also add March. Again, where did we get the 190 for January? That was already given to us here as the accounts payable beginning balance. The accounts payable, we assume it's going to be paid in full during the month of January. And then the 75% would be based on the net of the 840 minus the 24,000. So we already got the 612, which is this value here. 840 minus the 24,000 multiplied by 75%. For February, we got the 204, which is the 840 minus 240 multiplied by 25%. And we got the 567,000, which is the 780,000 manufacturing cost minus the depreciation expense 24,000. And we multiply that by 75%. Make sure that you clear or get the net value before you multiply by the 75%. For the last month, for the month of March, 25% will be multiplied by the previous month manufacturing cost, which is the 780 minus the 24,000 multiplied by 25%, and then the 591 would be the 812 minus the 24,000 multiplied by 75%. So that's the schedule of payments for manufacturing costs. Now let's complete the cash budget. So the cash budget is structured for a budget period as follows. We have the estimated cash receipts or cash collections minus the cash payments, which we already did both of these. So we get the amount of cash increase or decrease. If the amount of estimated cash receipts is more than the payments, we'll have a positive value. If the payments are more than the receipts, then we have a negative balance. So it will be a cash decrease, and the values would be between parentheses. We add this cash increase or decrease to the cash balance at the beginning of the month to get the cash balance at the end of the month. And that becomes the beginning balance for the next period. Okay, so make sure that this is going to be used in the next period. Then we compare that to the minimum cash balance to see whether we have an excess or a deficiency. So if the cash balance is greater than the minimum cash balance, then we have an excess. If it's less than the minimum cash balance, then we have a deficiency. So one more time, the budget balance at the end of the period is determined by adding the net increase or decrease for the period at the beginning of the cash balance. So this is what we have here. We add it to the cash balance. The ending balance is compared to a minimum cash balance to support operations as determined by management. So this is the minimum cash balance is a value that is decided by management. And if there's any difference between ending balance and the minimum cash balance, represents an excess or deficiency that may require management action. So let's see an example. Assume the following data for our company, Elite Accessories. So we have this is the beginning balance, 225. We have the quarterly tax paid on March 31st. We have the quarterly interest expense. We have the quarterly interest revenue received. We have sewing equipment purchased in February year 1. And we have some other selling and administrative expenses paid in month incurred, like in January, February, and March. So we have to prepare a cash budget using this information and an Excel sheet. So we start with the estimated cash receipts, and we already got that schedule of collections from sales. So these are the amount collected for each of the 3 months. Remember here we had interest revenue, 24.5, and that was in March 21st. So we go in March and we add the interest revenue, and that would be the total cash receipts. Then we subtract the cash payments. So we have the manufacturing cost, which you already prepared it in table or Excel sheet number 17, exhibit 17, schedule of payments for manufacturing cost. And remember, all of these should be in parentheses because we are going to subtract them from the cash receipts. Then we have the selling and administrative expenses that were given to us here. These values, these 3 values, the 160, 165, and 145. We have the sewing equipment, 274, that was in month of February. We have the interest expense, 22,500 in January. And we have the income taxes, 150 in March. We add all these numbers to get the total cash payments. And again, when I say all these numbers, it's only the estimated cash payment numbers. So once we get the total cash payments, we subtract that from the cash receipts to see how much, whether there's an increase or decrease. You see that in January we have an increased value, in February we have a decrease, and in March we have an increase. We add these values to the cash balance at the beginning of the month to get the cash balance at the end of the month. I think this plus is not accurate. This should be excluded. So it should be the cash balance at the end of the month. So these are the balances we have. We compare it to the minimum cash balance as management decided, and we put here a minimum cash balance of 340,000 or 340,000. That's what management decided for each month. So in month of January we have an excess of 28.5. In February we have a deficiency of 5,500, and in March we have another excess. Now let's talk about the other part, which is the capital expenditure budget. So the capital expenditure budget summarizes plans for acquiring fixed assets. So such expenditures are necessary as machinery and other fixed assets wear out, or sometimes they become obsolete. So in addition, purchasing additional fixed assets may be necessary to meet increasing demand for the company's product. So let's continue with our example. We have a 5-year capital expenditure budget for Elite Accessories Incorporated, and it's shown in the next slide in Table 19 or Exhibit 19. And as shown, the capital expenditure budgets are often prepared for 5 to 10 years into the future. So fixed assets often must be ordered years in advance, as it could take years to construct new buildings or other production facilities. The capital expenditure budget should be integrated with operating and the financing budget. So here we have the capital expenditure budget, and we have the machinery for cutting department, the machinery for sewing department, the office equipment. And here we have like year 1, year 2, year 3, and year 4, and year 5. And again, based on these lines, we decided the total to be these values. And again, these are just budgets. That's a capital expenditure budget. That's a long term. We have to plan ahead of time. Now we're going to see the budgeted balance sheet. So once everything is ready, we can prepare the budget balance sheet. The budget balance sheet, sometimes we call it the pro forma balance sheet, very similar to the pro forma income statement. It's prepared based on the operating and the financial budgets of the master budget. So both of them combined together, we prepare the pro forma or the budgeted balance sheet. Remember, again, I want to take you back so you can remember that the operating and financial budget, they're both used to prepare the balance sheet. So I'll take you back here so you can remember that. In this slide here, remember when we have the operating budget, that's used to prepare the income statement, and then we have the financial budget combined with the income statement, which is based on the operating budget. We prepare the budgeted balance sheet. So the budgeted balance sheet is dated as of the end of the budget period and is similar to a normal balance sheet, except that it's all based on estimated values. We are not going to have a balance sheet or a budgeted balance sheet for our example here, because again, it's all based on estimates. So just for simplicity, we're skipping that part. Alright, so let's check our knowledge again. Which budget summarizes plans for acquiring fixed assets? Is it the cash budget? Is it the budgeted income statement? Is it the capital expenditure budget? Or is it the cash payment budget? And the right answer in this case, since we're talking fixed assets, it's the capital expenditure budget. So the capital expenditure budget summarizes plans for acquiring fixed assets. Capital expenditure budgets are often prepared for 5 to 10 years into the future. Right, the last thing that we want to discuss in this chapter is some analysis for decision making. And here we're going to be talking about non-manufacturing staffing budget. So many non-manufacturing businesses often do not have direct material purchases budgets, or direct labor cost budgets, or factory overhead cost budgets. And because of that, the budgeted income statement is simplified in many non-manufacturing settings. We would only rely on staffing. So a primary budget in non-manufacturing business is the labor or staffing budget, which is highly flexible to service demands and used to manage staffing levels. So to use an example here, we're using Concord Hotel. It operates a hotel in a business district. The hotel has about 150 rooms that average 120 guests per night during the weekdays and 50 guests per night during the weekends. So here we are going to see the housekeeping staffing budget. So the housekeeping staffing Our staff is able to clean 10 rooms per employees, and the number of housekeepers required for an average weekday and weekends would be as follows. We have the number of guests per day, about 120 for the weekdays and 50 for the weekends. We divide that by the rooms per housekeeper, so each housekeeper can do 10 rooms. So the number of housekeepers per day that are needed are 12 for the weekdays and 5 for the weekends. So if we assume that each housekeeper is paid $15 per hour for an 8-hour shift per day, the annual budget would be as follows. We have, again, the number of housekeepers per day would be 12. The house or the hours per shift are 8. The days per year are 260. And these are, based on this calculation, 52 weeks multiplied by 5 business days or weekdays, which is going to be 260. The same thing for the weekends. The only difference is that 52 weeks with 2 days in the weekends, that's 104. Multiply these three numbers together, we get the total number of hours per year. Multiply the number of hours per year by the rate per hour, it's here $15. Sometimes employees or housekeeping staff get paid higher during the weekend, but in this case the rate is the same. So we multiply the number of hours by the rate, and we get the housekeeping staff annual budget for the weekdays and for the weekends, add them together, and that's the total budget, $436,800. That's how we do a calculated estimate for the staffing budget. I think this is very realistic. Of course, at the very end, the numbers would be plus or minus, but at least you know some kind of round figure based on objective calculation of what you are or what you expect to experience during a specific year. So by that, I conclude chapter 22 for budgeting. I hope that was helpful. Please read the chapter. Make sure that you go over everything that we discussed in this chapter, and I wish you all the best.